Let's continue our coverage of the impact of these U.S. tariffs announced by Trump yesterday. Our guest says previous tariff announcements and threats have been changed, so this might not be the last word on this subject. But he warns that business investment will stay weak, regardless of any additional measures. We're joined now by Nathan Janzen, Assistant Chief Economist at RBC Economics Research. Nathan, thanks very much. Can I give you the floor? What was your reaction when you saw these widespread tariffs announced by the US yesterday?
Yeah, I mean, I think, from a relative basis, in terms of which countries are targeted, there was a shift yesterday, obviously, where, significant tariffs on U.S. Imports from most countries, but kind of critically trade with Canada and Mexico that's compliant with the USMCA or CUSMA agreement, as we call it in Canada, being exempted from those tariff risks. So that is a change from what we had in the first months of the Trump presidency, where we saw tariffs kind of disproportionately, number one, implemented on China, but with the rest of tariffs also disproportionately targeting North American trading partners, including Canada and Mexico. So the good news is kind of Canada, from Canada's perspective, is on a relative basis. We're ranking at the low end now. In terms of overall tariff hikes that have been imposed by the U.S. economy. But that really, the big risk now is just that tariff hikes have been, so large in the U.S. on economies that they're threatening U.S. growth. So a relatively lower tariff rate for Canada might mean, that we get a larger share of the U.S. Import pie. But that's not much consolation if the size of that pie is shrinking as U.S. consumers and businesses pull back.
Yeah, we're looking at a chart here. I'm looking at the various tariffs. At this stage, Mexico and Canada, for all Trump's bluster about migrants and fentanyl, getting off pretty easy. I mean, it's incredible. What a tariff of well over 60% on China.
Yeah, I mean, getting off easy is again, relative. We have had significant tariffs imposed on Canada as well. If you think back to January, the effective tariff rate on U.S. imports from Canada was essentially zero, rounding to zero at around 0.1%. With auto tariffs that kicked in, today, that average tariff rate has increased to about, something like 3.5%. So in normal times, that would look like a very significant tariff increase, and it has been, but certainly much smaller relative to the planned tariff increases that were announced on other countries yesterday.
But famously, when the U.S. economy suffers, Canada's in the firing line too, and so you say we shouldn't be too complacent here if we do get a U.S. downturn.
Yeah, and that's where I think, the risks have shifted a little bit in terms of, what was driving the risk to the Canadian outlook. Prior to yesterday's announcement, it looked very much like Canada was at risk of, underperforming other regions. So having a relative economic shock, more significant tariffs imposed on Canada and Mexico. We're providing an incentive for U.S. importers to look for alternative sources for their imports at the expense of Canada and Mexico. And that's an environment where the Canadian economy could continue to underperform other of our advanced economy peers, and certainly the United States. So it's not like there are no downside risks going forward anymore for Canada. But the drivers of those risks, if this narrative, new narrative yesterday holds, and that's a big if. But if Canada is no longer the main target of U.S. tariffs, then the risks become more of what we traditionally experience in Canada, which is we are closely integrated to the U.S. economy. That won't change overnight. And that means that, what's good for the U.S. will be good for Canada, and vice versa. What's bad for the U.S. will be bad for Canada. So again, maybe we get a larger share of that U.S. import market marginally, but that doesn't help us if overall U.S. consumer spending and business investment is getting hurt by tariffs and the size of their import pie is shrinking.
Of course, America is in some ways a continent to itself, isn't it? Population well over 300 million. So they're relatively not that dependent on trade.
That's exactly, has been the view. The U.S. is less impacted by trade, less sensitive to trade disruptions than other countries, particularly Canada. Trade is 10% of U.S. GDP versus 30% of Canadian. So it's we're more sensitive to trade shocks. It's just the scale of the tariffs, that have been planned to be implemented by the U.S. announced yesterday are really unprecedented in a century. And so even with an economy that's less sensitive, to trade than other parts of the world, that potential tariff shock, and again, that will, what actually gets implemented will still likely evolve and change in coming days. But what was announced yesterday would be, the largest effective tariff hike in the U.S. and the highest effective tariff rate in the U.S. Since the early 1900s.
We're tight for time, but you don't see a near-term fix here for that perennial problem in Canada, weak business investment?
No, and that's really, one of the casualties of a trade war, with or without tariffs being imposed. And that's part of the reason for that is really it's been very difficult to predict which industries might be the target of additional tariff announcements or actually tariff implementation. And so what that does is it increases uncertainty really across the business sector, and uncertainty is a negative for business investment. So we've had a couple of decades now of significant underperformance in Canadian business investment, and it's hurting our productivity. And really, just the uncertainty of tariffs and trade disruptions alone are probably enough to keep that investment under pressure for the rest of this year as well.
Nathan, thank you very much. Nathan Janzen,